Welcome back to Supernova. Today, we'll be discussing about analyze and select investment opportunities, including mutual funds and exchange-traded funds, ETFs. Investing can be a great way to grow your wealth over time, but it's important to know how to choose the right investments. In this video, we'll cover the key factors you should consider when evaluating investment opportunities. Number 1. Define your investment goals. Investment goals refer to the specific objectives that individuals or organizations hope to achieve through their investment activities. These goals can vary widely depending on the investor's personal circumstances, risk tolerance, and time horizon. Some common investment goals include saving for retirement. Many people invest with the goal of building a retirement nest egg that can support them financially in their later years. Growing wealth. Investors may aim to grow their wealth over time by investing in assets that appreciate in value or generate income, such as stocks, real estate, or mutual funds. Saving for a specific goal. Some investors may have a specific short-term or long-term financial goal in mind, such as saving for a down payment on a home, paying for a child's college education, or starting a business. Generating income. Investors may seek to generate regular income from their investments to supplement their other sources of income. Preserving capital. Some investors may be more focused on preserving their capital and avoiding losses than on generating high returns. Having clear investment goals is important because it helps investors make more informed investment decisions. For example, if an investor's goal is to save for retirement, they may choose to invest in assets that have historically provided higher returns over the long term, such as stocks or mutual funds, rather than low-risk investments like savings accounts or bonds that may not generate enough returns to meet their retirement needs. By understanding their investment goals, investors can also develop a clear investment strategy and adjust their portfolio over time to ensure they stay on track to meet their goals. Number 2. Understand the types of investments. Understanding the different types of investments is important because each type of investment has its own unique features, risks, and potential returns. Here are some common types of investments. Stocks. Stocks represent ownership in a company, and investors buy shares of stock in the hope that the company's profits will increase, resulting in higher stock prices and potential capital gains. Stocks are generally considered to be more volatile than other types of investments, as their value can fluctuate rapidly based on market conditions. Bonds. Bonds are debt securities issued by companies or governments to raise money. When an investor buys a bond, they are effectively lending money to the issuer, who promises to pay back the principal and interest at a predetermined rate. Bonds are generally considered to be less risky than stocks, as their value is less affected by market volatility. Mutual funds. Mutual funds pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. This allows investors to access a diverse range of investments with relatively low minimum investments. Mutual funds are professionally managed and charge fees for their services. Exchange-traded funds, ETFs. ETFs are similar to mutual funds in that they offer investors a diversified portfolio of investments. However, ETFs are traded on an exchange like stocks, allowing investors to buy and sell them throughout the day. ETFs generally have lower fees than mutual funds. Real estate. Real estate can be a profitable investment for those willing to take on the risk. Real estate investors may buy and hold properties for rental income or to sell at a profit, or they may invest in real estate investment trusts, REITs, which are companies that own and operate income-generating real estate properties. Commodities. Commodities are raw materials such as gold, oil, or agricultural products that can be traded on markets. Investing in commodities can provide diversification benefits, but is generally considered to be more risky than other types of investments due to price volatility. Cryptocurrencies. Cryptocurrencies are digital assets that use encryption techniques to secure transactions and control the creation of new units. Cryptocurrencies are a relatively new and highly speculative asset class that can be extremely volatile. By understanding the different types of investments, investors can build a diversified portfolio that balances risk and potential returns based on their investment goals and risk tolerance. Number 3. Evaluate investment performance. Evaluating investment performance is an important part of managing an investment portfolio. Here are some key factors to consider when evaluating investment performance. Return on investment, ROI. The ROI is the gain or loss on an investment relative to the amount of money invested. To calculate ROI, Divide the investment's gain or loss by its original cost. ROI is a useful measure of investment performance because it allows you to compare the performance of different investments regardless of their size. Risk-adjusted return. Risk-adjusted return is a measure of how much return an investment has generated relative to the amount of risk it has taken on. This is important because investors generally prefer investments that generate higher returns for the amount of risk taken on. One commonly used risk-adjusted return measure is the Sharpe ratio, which compares an investment's return to the risk-free rate, usually the yield on government bonds, and its volatility. Time-weighted return. Time-weighted return is a measure of an investment's performance that removes the impact of external cash flows, such as deposits or withdrawals, over time. This is important because it allows investors to evaluate the performance of the underlying investments without being skewed by the timing of cash flows. Benchmarking. Benchmarking is a way to compare an investment's performance to a relevant market index or benchmark. This can help investors evaluate whether the investment has outperformed or underperformed its peers over a certain period of time. Costs. The costs associated with an investment can significantly impact its performance over time. It is important to consider not only the fees charged by the investment itself, but also any trading costs, taxes, and other expenses associated with owning the investment. Diversification. Diversification is an important factor to consider when evaluating investment performance. A well-diversified portfolio can help reduce risk and improve overall performance. By considering these factors and regularly evaluating investment performance, investors can make informed decisions about their portfolios and adjust their investments as needed to achieve their financial goals. Number 4. Analyze the investment fees. Investment fees are the costs that investors pay to purchase, hold, and sell investment assets such as stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Analyzing these fees is important because they can significantly impact an investor's overall investment returns. Here are some key factors to consider when analyzing investment fees. Expense ratio. The expense ratio is the percentage of a mutual fund or ETF's assets that are used to cover its operating expenses. This includes fees for investment management, administration, and other expenses. Generally, lower expense ratios are better, as they leave more of the investment's returns for the investor. Load fees. Load fees are sales charges that investors pay when purchasing or selling mutual funds. Load fees can be front-loaded, paid at the time of purchase, or back-loaded, paid when the investment is sold. Some mutual funds may also charge redemption fees if the investor sells the investment before a certain period of time has elapsed. It is important to carefully consider these fees when choosing mutual funds to invest in. Trading costs. Trading costs include commissions paid to brokers, as well as any other fees associated with buying or selling securities. These costs can add up quickly, particularly for frequent traders. For long-term investors, it may be more cost-effective to choose investments with lower trading costs or to invest in funds that have no trading costs. Taxes. Taxes are another important factor to consider when analyzing investment fees. Capital gains taxes and other taxes can significantly impact investment returns, particularly for short-term investments. Tax-efficient investments, such as index funds or tax-managed mutual funds, may help investors minimize their tax burden. Other fees. There may be other fees associated with owning certain types of investments, such as real estate or alternative investments. It is important to carefully consider these fees when evaluating the potential returns of these investments. By carefully analyzing investment fees, investors can make more informed decisions about their investments and potentially increase their overall investment returns. It is important to carefully read and understand the fees associated with any investment before making a purchase. Number 5. Consider investment risk. Investment risk is the possibility of losing some or all of your investment due to factors beyond your control, such as market volatility, economic events, or company-specific issues. When making investment decisions, it is important to consider investment risk to help ensure that your investment goals align with your risk tolerance. Here are some key factors to consider when evaluating investment risk. Risk tolerance. Your risk tolerance is a measure of how much investment risk you are willing to take on. It is influenced by factors such as your investment goals, time horizon, financial situation, and personal preferences. Understanding your risk tolerance is important when evaluating investment options, as it can help you choose investments that are appropriate for your individual circumstances. Investment horizon. Your investment horizon is the length of time you plan to hold an investment. Generally, longer investment horizons allow for greater risk-taking because there is more time to recover from any potential losses. Shorter investment horizons, on the other hand, may require more conservative investment strategies. Asset allocation. Asset allocation is the process of dividing your investment portfolio among different types of assets, such as stocks, bonds, and cash. Diversification through asset allocation can help reduce investment risk by spreading it across different types of investments with varying risk profiles. Investment strategy. Your investment strategy should be aligned with your investment goals and risk tolerance. Some investment strategies, such as growth investing, may be more risky but offer the potential for higher returns over the long term. Other strategies, such as income investing, may be less risky but offer lower returns. Economic and market conditions. Economic and market conditions can impact investment risk. For example, during times of economic recession or market downturns, investment risk may increase. It is important to monitor economic and market conditions and adjust your investment strategy accordingly. Number 6. Diversify your portfolio. Diversifying your portfolio refers to the practice of investing in a variety of different types of assets in order to minimize risk and maximize potential returns. In other words, instead of putting all your money into a single investment or type of investment, you spread it across different investments to reduce the impact of any one investment's performance on your overall portfolio. Diversification can take many forms, including investing in different asset classes such as stocks, bonds, real estate, and commodities, as well as investing in different industries and sectors. The idea is to create a mix of investments that are not all affected by the same economic and market factors, so that when one investment is performing poorly, other investments may be performing well enough to offset the losses. By diversifying your portfolio, you may be able to reduce the overall risk of your investments while potentially increasing the likelihood of achieving your financial goals. However, it's important to keep in mind that diversification does not guarantee profits or protect against losses. It is always important to carefully consider your investment goals, risk tolerance, and time horizon before making any investment decisions. That's it for today's video on analyze and select investment opportunities, including mutual funds and ETFs. By following these steps and considering your investment goals, you can make informed investment decisions that can help you grow your wealth over time. Thanks for watching and be sure to subscribe to our channel for more helpful investment tips.